how much is this really worth? Is $5,000 an ounce a lot? Is $10,000 an ounce a lot? Yeah, I know you wish you'd have bought it at 248 or, I don't know, how about 20 bucks? Because that's what it was once. Based on the most current data that I was able to pull for the level of debt, which is what creates the fiat money. So you use that as a proxy for all the money that's out there. And as I showed you, with physical gold and physical silver, both of this is the same, there's a finite amount. That means that this one little ounce that I'm holding in my hand, it's not worth 5,000 or 10,000. It's worth 36,000.
Gold will reflect all the problems that are coming. A potential target could be $38,000. It's not a forecast, but I will talk about later in this video how we get to that.
Gold is increasingly viewed not just as a commodity, but also as a measure of the expanding global debt system. As fiat money grows alongside rising liabilities, the finite nature of physical gold highlights a significant imbalance. When compared against total debt and currency supply, current price levels may understate gold's real value, suggesting a much higher revaluation over time. Egon von Greyerz, a longtime advocate for wealth preservation through tangible assets, and Lynette Zang, a financial analyst focused on currency cycles and systemic risk, emphasize that gold's true worth lies in its scarcity relative to unlimited money creation. Building on the idea that debt serves as a proxy for global liquidity, they explain that the implied valuation of gold can rise far beyond current market prices, suggesting figures around $36,000 to $38,000 reflect a recalibration rather than mere speculation. This perspective connects to the broader expectation that gold will increasingly mirror underlying financial stress. As monetary expansion continues and confidence in fiat systems weakens, the role of gold as a stable store of value is expected to become even more pronounced. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Interest rates have gone from 16%, that's measured on the 10-year US Treasury bond. In 1980, there was 16%. And it was down to 0.5% in 2020. Now we're just over 4%. My forecast, as this graph shows, is that we are going to go above the 16% in the 1980s. I think we could overshoot it by a big margin for the simple reason that inflation will be higher than it was in the 1970s, and there'll be many more defaults than we saw in the 1970s. And I would expect in this coming era that we also see sovereign defaults. The US will definitely default in one way or another. Doesn't mean that they go bankrupt, but it means that the currency will go to zero and the money printing will be unlimited. So that virtually will lead to US Treasury bonds being worthless, and therefore interest rates could even go a lot higher than the 16 to 20% that we saw in the 1970s. It could go a lot higher even. Now, of course, people will suffer dramatically with these high interest rates. I saw just a recent article, fishermen in the North Sea. It used to cost them £5,000 to go out with their boat to fish haddock, and now it's up to £10,000. It's doubled in a very short period of time. That means higher prices for consumers, lower income for the fishermen, and losses within the system. And that's just one example. It will happen throughout the system. There will be massive inflation and there will be misery because people cannot afford the higher prices, and all governments can do is just to print more money and make the currency more worthless than it is now. And it's, as we know, and I talked about many times, already gone down by 99% since 1971. That is against gold, dollar, euro, yen, etc. And they've all gone down 99%, and it's only 1% left. So this will just not have consequences for markets, bond markets. That will, as I said, crash, but also for stock markets. Stock markets are now starting a major downtrend. Before this is over, I see the Dow Jones and the Standard & Poor's go down by 90 to 95% against gold. And gold is really only measuring in real terms. So if you look at the graph here, it shows how we've already gone down 75% since 1999. That is, the stocks or the S&P has gone down 99% versus gold since 99. Now, from this level, I expect another fall of 95% before this era is over. And that fall could happen very quickly. It could take a few years. And then after that, it goes along the bottom, maybe for 5, 10 years or longer. So this is a massive shift from paper assets to real assets. And anyone who gets caught with the paper assets and does not shift into real asset is going to lose all their wealth in coming years. I repeat, you are going to lose all your wealth if you don't shift to real assets. And that is not a joke. That is absolute reality. And please don't wait for the market to recover before you sell. Sell now. Sell before it reaches the low levels. You can never sell at the top. Now is a good time to sell. Now is a good time to switch to gold. Remember, so gold is going to go up substantially, but that is measured in dollars or in euros or in yen. But actually, in real terms, gold is not going up. It's never gone up. Gold maintains stable purchasing power. I've looked at the ratio between a cow and gold. Since we can't measure gold in money terms because money goes down in value by the day, why not measure it in something real that everybody consumes? That is, for example, a cow. And over the last 5,000 years, a cow in gold terms has cost between around half an ounce of gold to just over 1 ounce of gold. That is quite remarkable. Think about that. Cow has not gone up by more than half an ounce of gold maximum over a 5,000 year period. It shows you that when you look at your wealth in paper money, it's absolutely the wrong measure to use. Think about instead money in real terms. Think about money in gold terms. That's the only way to measure your wealth. So what is the consequence of this? Of course, the consequences are dire. It'll be collapse of the financial system. There'll be a collapse of the many banks, maybe the majority of the banking system. It'll be restructured at a massive cost. There'll be collapse of the bond market and, of course, of the stock market, as I said, and times will be very tough. So in money terms, which, as I said, is not the way you should measure gold. You should just take gold as stable purchasing power. But if you want to look at it in money terms, because if you keep your money in currencies, in dollars, in sterling, pounds, or in yen, then you're going to lose all of your wealth. But if we measure it in real terms and adjust it for inflation, gold adjusted for real inflation, this is the way that inflation was calculated by the US government in the 1970s. Then, if you adjust it for that, the gold price of 1980, which was $850 at the high in 1980, that gold price today would be $38,000. $38,000. And that is actually not a target, as I said earlier on. That is just coming back to the inflation adjusted level as it was in 1980. And in this coming era now, it could happen very quickly or it could take a few years. We will see at least that price in paper money and probably a lot more because, as I said, there'll be massive amounts of paper printed. So please buy gold, buy physical gold, store it in a safe place, in a safe jurisdiction outside the banking system. Also buy some silver. Silver is now massively undervalued and is likely to go up a lot faster than gold for quite a time.
Rising interest rates, accelerating inflation, and expanding debt are signaling the end of a long monetary cycle. After decades of falling yields, the trend is reversing, with the potential to exceed historic highs as financial stress builds. This shift is not just cyclical, but structural, pointing toward deeper instability across global markets. As inflation intensifies and debt levels become unsustainable, the risk of sovereign defaults and currency debasement increases significantly. Bond markets could face severe pressure, while equities may decline sharply relative to real assets. In this environment, gold stands out as a stable benchmark of purchasing power, maintaining value over long periods despite currency erosion. Historical comparisons show that when adjusted for real inflation, gold's past highs translate to significantly higher levels today, with potential for further upside as monetary expansion continues. This dynamic suggests a major transition from paper assets to tangible stores of value, where preserving wealth becomes the primary objective amid widespread financial disruption. Let's get back to the interview.
What's the fundamental value of this stuff? Well, the Federal Reserve purchasing power of the consumer dollar tells you all the time. It's actually the same as this, which is zero. It's a big fat zero. But the fundamental value of gold and silver, well, let's do that exercise again, because this is sound money. This is fiat money. They're both money. They're just the flip side of the coin. Governments create this. Corporations, I should say, corporations create this, because that's what the Federal Reserve is. God created this. So gold and silver are the only true forms of money that were not created by man. And every other, no exceptions, every other money that was created by man has gone the way of the dodo bird. It simply loses all value when the confidence is lost. So how much is this really worth? Is $5,000 an ounce a lot? Is $10,000 an ounce a lot? Yeah, I know you wish you'd have bought it at 248 or, I don't know, how about $20? Because that's what it was once. But based on the most current data that I was able to pull for the level of debt, which is what creates the fiat money. So you use that as a proxy for all the money that's out there. And as I showed you, with physical gold and physical silver, both of this is the same, there's a finite amount. That means that this one little ounce that I'm holding in my hand, it's not worth 5,000 or 10,000. It's worth 36,000. Well, when you go to the store and something is on sale that you know is typically worth a lot more than what they have it on sale for, what do? Do you go, oh no, I don't want to buy it yet because maybe the price will get a little cheaper? Or do you buy all you can fit in your cart? That's what I do. That's what most people do. Do not be fooled by the lies, because we will come to a point where we will not even be able to lay this in other words, buy it. So you do it when you can, as you can, and get that strategy in place and executed. And if spot gold, if gold, not spot, if the true value of an ounce of gold is 36,000, then that means that the true value of an ounce of silver is 1,800, not $100 or $90 or $80 or $70. It's a flipping bargain. And so what should you do? Continue to accumulate while you can execute the full strategy. Because frankly, there's gold and then there's gold. There's silver and then there's silver. What do you want for your protection? You need to have a lot of all of the above, right? Because it depends on what it is that you're trying to accomplish. And I have to remind you of this because it's critically clear, and I haven't shown you this for a while. But this is a paper from the Bank for International Settlements. Who are they? They're the central banker's central bank. So you could say that they are the biggest and most important bank in the world. And they did a study on what share for gold on the interaction of gold and foreign exchange reserves. Okay, and what do they say about gold? Well, first, they say that gold is an asset viewed by many as durable and largely imperishable. Yeah, it is. Right? It's indestructible. It's one reason that it can be the primary currency metal. And it refers to it free of default risk. The BOPM, precious metals, clearly establishes that gold bullion is the only case of a financial asset with no counterparty risk. No counterparty risk. It's not entirely true on bullion because there is the confiscation risk. That's why personally, because I lived through that myself, I lived through it. This is not hearsay. This, in 1964, my uncle had at least 3,000 ounces of these because this was the only legal way to hold it. It's significant. So gold, the only financial asset that runs no counterparty risk. Unlike currencies and debt, which are claims on foreign governments or institutions, Gold kept at home is not subject to political manipulation. These are not my words, my friends. These are the Banks for International Settlements, and you could go read them yourselves in the conclusion. Third, gold has been empirically proven to serve as an inflation hedge, at least over longer periods of time. So yeah, anything can happen in this paper manipulation. That's easy peasy. But what we're seeing right now, you better have gold and silver in place. What if this is officially World War III? You could easily lose your ability to position into this. Don't let that happen. I'm telling you, you don't want that to happen. I would rather be 10 years too early than 1 second too late, because that's when I lose all of my choices. And fourth, last, its most widely recognized feature is its potential value in highly adverse scenarios.
Gold and silver are increasingly being viewed as foundational money rather than speculative assets, especially as confidence in fiat systems continues to erode. As global debt expands and currencies lose purchasing power over time, the contrast between finite physical metals and unlimited money creation is becoming more pronounced. This dynamic is driving a reassessment of what these assets may truly be worth in a stressed financial environment. As monetary systems face mounting pressure, the argument for higher intrinsic valuations of gold and silver gains traction. When measured against total debt and currency supply, current prices appear disconnected from underlying fundamentals. At the same time, institutions continue to recognize gold's unique role as a durable asset with no counterparty risk, reinforcing its position as a long-term store of value. In periods of instability, this characteristic becomes increasingly important as investors seek protection from systemic risks. The broader trend suggests a gradual but powerful shift toward tangible assets, where preserving purchasing power takes priority over nominal gains in traditional financial instruments. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.